Our next guest says the 60-40 portfolio is up from its deathbed and performing better, but says it may be time to trim big tech names. Let's bring in Carol Schleif, Chief Investment Officer of BMO Family Office. Carol, good morning. It's good to see you. So it's true, the balanced 60-40 equity fixed income portfolio is certainly doing better. Last year was one of its worst years in generations. But does that mean you think it's still attractive from here? Stocks and bonds have been moving in opposite directions in terms of price. So I guess that could offset the risk, but does it mean it's an opportunity?
It does mean it's an opportunity. It was interesting last year, people declaring the death of the 60-40, and it was, as we all know, such a historic year with double-digit declines in both of those markets. But having a balanced approach to risk, whether it means the kinds of equities you're buying in your portfolio, so you've got some conservative, some more aggressive in there, so you're balancing off the risk, or balancing the needs in your portfolio where bonds are still generating nice income, even if the prices are moving around a lot. Getting 5.25% is pretty attractive for a lot of people.
For sure, and that has definitely attracted a lot of fresh money. In terms of the equity market, what's your read on the activity recently? It seems like you could easily frame it as pretty routine, seasonal pullback after a nice rally. On the other hand, it seems like the equity market's very sensitive to every bump higher in bond yields, and we have not yet quite called off the vigil for a potential recession.
Yeah, exactly. And if you look really short term, as in this week, last week, you've got a lot of bouncing around which is unusual for this time of year. We used to have a summer lull, which nobody's seen for the last few years. But the market volume is so light that you're seeing a lot of pushing around on news. But you've also got a lot of people really focused on every data point, trying to figure out what the Fed's going to do next. And we are moving into that traditionally can be kind of seasonally scary period for the stock market as it relates to September and October. Some of our biggest declines have come then. There's lots of news coming in September and lots of potential headlines to drive things around. So we think keeping that balanced approach to risk and keeping a foot in a lot of different camps, playing on different potential outcomes still makes a lot of sense. So
staying balanced, does that mean that you wouldn't just stick with what's been winning so far this year within the equity market? I mean, you mentioned maybe time to trim in tech. Where else might be a better place for fresh money?
Well, I think looking at it, you don't want to not be weighted in tech, especially given the way things are going intermediate and longer term and the trends in the economy with artificial intelligence, the infrastructure rebuild, the greening of the grid. You don't want to be unweighted in there, but it's important to in calmer times, make sure you've set ranges for upper and lower bounds of where you want to own, and things that have run up. It's interesting it's probably time to trim some of those gains and look at other places to put it. Some of the things that have underperformed are broader markets in general. As we know, through May, there were basically 7 to 10 stocks that carried the bulk of the market. So looking at some of the other capitalization styles, looking globally, not necessarily being overweight there, but looking globally at some of the different pockets that have been really beaten up, and poking around to see if there's green shoots in some areas.
We are waiting for another inflation data point here that, people will certainly react to and build into their Fed expectations. Are you confident in this disinflation trend that we have right now, that it's set to continue and the Fed can more or less kind of halt here?
We're definitely hopeful that that's the routine. We think the last few hikes haven't necessarily been needed from a pure economic standpoint, although maybe to temper expectations in the markets they were needed. But the Fed has given itself plenty of room, and the economy has given us some breathing room, if you will, with recent data to have the Fed be able to pause and stay. But we still think there's a lot of adjustment that investors need to do, because we're not quite sure that they're in the camp of higher for longer and what that longer period looks like.